the months of August just being a terrible month in terms of China's economic data. We have seen some of the worst data coming out of China for a very long time. The lowest output, factory output for 6 years, and so a lot of bad figures. So it's actually the first piece of good data that came out of China, but it kind of pales in comparison to what we learned about August. So I think the month of really bad data from August really prompted a lot of people to urge Beijing actually to undertake a kind of more aggressive monetary policy or effort actually to stimulate the Chinese economy.
Despite the good data around manufacturing, though, has most of the data that's come out recently out of China been a sign that the Chinese economy is weakening a lot faster than anyone thought?
Yes. Like basically, if you look at economic data across, credit creation, the supply of money, and you look at a factory output, you look like electricity consumption or generation, all this data point towards a quite gloomy picture. So there's good chance that China may not be able to reach its economic official kind of goal of 7.5%. So today's data is only bits of information, but even then it only improved very slightly and is not based on domestic consumption. So there's actually the rebounding manufacturer purchasing index is actually based on a resumption of export. So I think, the overall the data points to a rather a bad picture for China's economy.
Now, China went through a massive stimulus in the financial crisis, and then there was some interesting bits of stimulus happened recently where they gave $100 billion to 5 of the major banks. Are global investors hoping that China re-embarks on a new stimulus program?
No. I think if you look at even the $100 billion the central bank allocated to big 5 commercial banks is actually a short-term loan in a way. It's only for 3 months. It's basically anticipation of a kind of a crunch in cash supply in the months of October, which is a long week of national holiday and a few other stock offering. So that's very temporary, and the central bank has been very, very reluctant to do anything dramatic like cutting the interest rates or even lower the reserve ratio of all the major commercial banks. So the central bank is definitely very reluctant. And also the Chinese finance minister, who last Sunday was in the Cairns for the G20 finance minister meeting, and he actually made it very clear that there will be no significant change in economic policy just given on the basis of any of these economic indicators. So, and also the Chinese top leaders gathered in Beidaihe, like this, their favorite holiday home, and they actually decided they would put a structural reform ahead of a stimulus. So I think all the indicators are saying that don't expect a large-scale stimulus from Beijing for the remainder of the year.
So this is a terrible perfect storm for Australian iron ore miners, because last time it was the China stimulus that helped boost the iron ore price up to those record highs, but there's not going to be sort of infrastructure investment in the same way here in China, is there?
Yeah, no. I think basically if you look at it, people keep saying or thinking that 7.5% or 8% is basically going itself, but it's not. It's actually linked to employment number. If you actually look at the employment number, the Beijing leadership is fairly relaxed about it because the unemployment situation in China is under the control. And actually there are a lot of job vacancies in the coastal area. So before 6 years ago, every 1% increase in China's GDP created 1.2 million jobs. Now, for every 1% increase, it created 1.8 million jobs. And China needs to create 10 million jobs every year. If you do a basic calculation, China needs less than 6% to create a number of jobs. So employment is absolutely one of the bottom lines for Beijing. So they can't afford any social disturbance. At the moment, the employment situation is under control. So I think that's why the Chinese government is a lot more relaxed than analysts here.
And this is the sign that China is really rebalancing away from manufacturing, export-led economy back into a consumption economy, or into a consumption economy.
It is actually happening. If you look at the GDP data, service is nearly 50% of China's economy, and the manufacturing is 41%. The consumption in China is kind of slowing down a little bit, but it is one of the fastest growing consumer spending or expenditure amongst the major economy. So China is actually spending a lot. The Chinese consumers and the wages in China are growing at a double digit. So I think that it is the sign that the consumption economy is taking off, and the service sector is actually 50% of the economy, and Alibaba is actually a great example of the new Chinese service economy, this flourishing e-commerce sector. And some of the Chinese delivery company have tens and thousands of delivery drivers. This is the new Chinese economy.
Peter Tsai, thanks very much.
Thanks, Jackson.